Hi, everyone. Welcome to your latest Glass Half Full. Ryan and Sonu, always Sonu. I'm in New York City. There it is. There's beautiful
Yeah,
Bryant Park behind me. Where are you right now?
I am not too far from you, actually. I'm in Greenwich, Connecticut, out by the harbor. So I'm in my hotel room on the balcony. It is a little cool
Nice.
outside for like April 2nd, which is when we're recording this.
So I walked outside to record this. It's like raining. I was like, ooh, my umbrella's in the hotel. So I found a nice, there you go. See, I have a nice
Okay.
cover. I have the Bank of China right in front of me. So thank you, Bank of China, for the cover. All right, Sonu, let's get into it. It ain't over till it's over. President Trump
Yep.
spoke on Wednesday. You and I recorded this on Thursday. Oil soaring. Markets don't like it. What's going on?
Basically, oil's not flowing through the Strait of Hormuz.
Yeah.
And a couple of days ago, markets rallied for 2 straight days on March 31st and April 1st. We got some big rallies off the lows. You can talk about whether you think those lows are going to stick or we're going to break further down. But I think it depends on the outlook, right? And a big part of that, as I said, is the oil needs to flow across the Strait of Hormuz. And the president's speech wasn't really clear as to whether the hostilities and the crisis in the Middle East ends this week, or does it end 2 to 3 weeks from now, or does it end a month and a half from now, right? So if the oil doesn't flow, and it's not just about oil, it's about all sorts of petroleum products that are derived and refined and all of that you need oil for, whether it's in Asia and then Europe and even in the US. The US is a net exporter of petroleum goods. I think we've talked about that before. But we are a net importer of oil by itself. Petroleum products means it's oil, and a lot of what we export is natural gas, right? But we need oil for our refineries, including on the East Coast. There's a reason why nationwide average gas prices are up to $4.08 a gallon. Diesel prices have been soaring through the roof as well. So we're not immune from this. And ultimately, yeah, it depends on when the crisis is over.
Well, the reality, the time we're doing this, at least, the crisis is not over. Some things to think about here. We've talked about some of these concepts, but the S&P 500 before the bounce, earlier
Hmm.
this week, was down about 9% peak to trough.
Yeah.
Sonu, a year ago, right now, we had a 10% peak to trough correction last March. Then we bounced a little bit, and then we crashed after Liberation Day. Here we are again with news driven in early April. But last year, why did we fall in March? Does anyone really remember? Listen, we do this for a living. Not sure I remember. I know there were some worries about DeepSeek and tech AI.
Technology, and seems like here we are again, right?
The reality, most years of volatility, we are not minimizing the headlines. But the one thing to think about in about 2 weeks, who knows, maybe the war's over in 2 weeks, but in 2 weeks, earnings season starts. We continue to see strong earnings, strong profit growth, strong profit margins. And we'll see what corporate America has to say about that. But the reality is New York City's pretty busy right now. I'm sure Connecticut is. Is this really impacting people? Yes, to a degree because of the higher energy prices, potentially the fallout there. But for right now, the economy's still hanging in there, right? What about the labor market? Let's talk about the labor market for a second.
Yeah, look, the economy is hanging in there, which means corporate profits are more than hanging in there because corporate profit expectations, as you said, have been going higher. These expectations, not what happened in the past, too. Profit margin expectations are also moving higher to record levels, 15% forward-looking margins for the S&P 500. The labor market is in the same state it's been in for about a year and a half now. We are in a low hiring, low firing economy. Companies are not laying off workers. That's good if you have a job. But if you don't have a job, it's a pretty hard environment to find one. And that's because, I think there's a lot of blame. I think blame is the right word here, attributed to, oh, it's AI. That's why hiring is low. I don't think it's quite that. I think one reason is companies overhired in 2021 and 2022. They're scaling back. And the second reason is, why are they scaling back hiring? That's because of economic uncertainty. Last year we had the tariff issue, and just as we got out of that, now we have inflation issue. But look, a manufacturing sentiment index came out this week, and it
Yep.
shows that manufacturing is still sort of expanding. Manufacturing activity is expanding. That's a positive sign. Now, of course, the other side is prices also increasing. We know that, and especially gas prices, and then steel and aluminum tariffs, and that sent prices higher too. But activity is expanding, and that's why you want to be careful in a situation like this by thinking, oh my God, there's a crisis, we should sell stocks. Doesn't quite work like that. What you want to be in this, what this sort of crisis, especially an inflationary regime, does is it shifts the winners and losers, right? Obviously, we know what energy companies doing well, but it's not just energy companies. Industrials may be doing well too, aerospace and defense and things like that. So this is not a recommendation to go out and buy any of this stuff, but ultimately you want to have a diversified portfolio.
No, well said there. We're getting near the end of the latest glass half full. It ain't over till it's over. Just some other things to think about here. Yes, the S&P 500's had a rough start to this year, no question. We gained over 20% 2 years in a row and high teens last year. It's a midterm year. Those tend to be more volatile, especially early in a midterm year. These are all things that said maybe it was time for a break, and clearly we've had that. I mean, we clearly had that. But I think it's really important to remember what you just said, Sonu. We looked at over 40 major geopolitical events throughout history since World War II. Stock market's down a month later and about flat 3 months later. Well, we're down a month later. It's conflict. Maybe we're flat 3 months later. But the market has a funny way of kind of getting used to where things are. I've said this before, Burt Water, CEO, it's not about good or bad. It's about better or worse. There is a lot of bad stuff priced in, rightfully so, with everything going on. But markets have a way of getting through that and getting past that. And we don't think this time it's going to be any different. Sonu, probably we need to wrap it up. Any final comments on the final glass half full?
Look, the average year sees a pullback from peak to trough for the S&P 500 for about 14%. We haven't hit that this year. We didn't hit that in 2023. We didn't hit that in 2024. Right? Now, last year, after Liberation Day, we did. But you should be expecting at least a 10% pullback once a year. We've got one so far in the last 4 years or 3.5 years. So if we do get one, yeah, that's just par for the course. That's part of investing.
And this is the joy of doing live. We kind of blew up there for a second, but you know what? It's okay. Because I think Sonu ended things talking about volatility. I'll kind of bring us home. I just hit a hit from the New York Stock Exchange. Check it out. See? There's the New York Stock Exchange. This was not your average glass half full the way we had to do this, but, sometimes things happen for a reason. Listen, everybody, thank you so much for watching these weekly glass half fulls. We're going to keep doing them. We really appreciate it. A lot of volatility, a lot of uncertainty, a lot of bad stuff is floating out there, but there's always a glass half full. There's still reason to be optimistic. We still think it's going to be a pretty good year for investors when all is said and done. With all that, we'll see everybody next time. Take care. Thank you.